Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so over here, again, not just to show you a bullish and a bearish engulfing pattern. And notice how this bullish engulfing pattern over here became a support level. And that's what happens a lot. And so in this scenario, let's say it's a bad risk-reward. And we don't have to go over this exactly as an option trade, but let's say it's a bad risk-reward, and you don't want to do the option trade here because your profit potential is not in there. One of the things that we'll do in our trading is set up an alert actually on our charts. And if the market gets anywhere near the support area, as it did here, as it bounces off support, and then if we have a good risk-reward, then we'll do the trade. So just because you get a bullish engulfing pattern doesn't mean it's going to be a great trade, because sometimes by the time you get the signal, you may not want to do the trade. And this gets back to the question that Josh asked about, the percentage of times that the candle patterns would work. I would not be buying on this bullish engulfing pattern. The market rallied too much of a risk on the downside, whereas another bullish engulfing pattern, maybe this little one over here, might be presenting a better risk-reward. So,
great point.
Okay, and this is what it's about with the engulfing patterns, and just again to echo the importance of what the candles will show us. Combinations of bullish and bearish candle lines indicate the direction of the market, and investors, and this is what the Japanese always refer to, and this is, again, a quote from another Japanese book, investors' psychological conflicts at important turning points. And this is such a great example of this. Look at this. Quickly reading the market's message. Okay, so here the bulls are in charge. The bulls can't hold control. Bearish engulfing pattern. Bearish engulfing pattern. Bearish engulfing pattern. So a group of bearish engulfing patterns right at the same resistance area. Really, to me, it's kind of like a coiled spring. It's just building up a lot of pressure when you release the trigger, when you release the tension. Boom. Now, in this case, Stephen, let's say let's say our target is kind of maybe down here. So we start doing some option trades, whether it's outright puts or a bear put spread, and I'll leave it to you to tell me what you would suggest. But let's say whatever you do, and then you see this and you want to get more aggressive on the trade, and then you see this and you want to get more aggressive on the trade. How would you do that? Or how would you do that? So in other words, you do a trade here, but then you want to get more aggressive over here, or maybe over here.
Well, you can increase your size, or alternatively, and now you have to always think about your trading commissions, because every time you're altering your position, that might be costing you a lot more money. So again, maybe adding to your position might be the easiest way to do it, because another idea might be to sell out your spreads that you have on and roll them down to lower strikes, which might give you more leverage. But the problem with that is that if you have to trade so many contracts, by closing some and buying others, it might be better to just keep your same position on and add a couple more contracts with the same exact position that you had before, if you were increasing your confidence level.
Okay, great. Okay, if I'd only known this. That's what education is all about. Now, this is interesting. This is a breakout, and the market broke out just barely above a resistance area. But what was interesting is that it was a small real body. And what that means is that we should not be adding to long positions here. And if you do buy, I'd be buying very, very lightly. So two questions, Stephen. Let's say we do view this as a breakout. We're not very confident. We would want to be bullish on that breakout. Okay, so what kind of option trade would you do? That's question one. And then question two is, let's say on the next session, and I don't know if people psychologically we could do this from turning from bullish to bearish, but let's say we're completely rational and we could do this. The next session, the market fails, and you want to be short. You want to be short with a downside target to here. So we're lightly along here, but then we turn bearish over here, and we want to be quite aggressively bearish. So what are the two trades we could be doing? One here and then one over here.
And again, keeping with the spread strategy, I guess I'm looking at the, something like the 122, 120, is it 23, 24 spread, maybe it's maybe 124. The problem is, I'm going to be honest with you, all my years of trading, I might be able to bail out on that first red candle. Right. But I would say, at least me personally, some of the attendees might be able to do this. I can't really turn around from being extremely bullish to extremely bearish. I would be really happy to get out of my long on that first red candle. Okay. That I would consider that a huge success if I would have just lost maybe 10 or 20% of my capital on that one trade, because I reversed my position rather adroitly, because obviously the next candle is a disaster for the longs. So that's the way I would trade it. But for those that are really, really aggressive, you might turn around and sell your call spreads and buy put spreads, or maybe sell your call spreads and go short the call spreads. Mm-hmm. A couple ideas.
Now, let's say you're flat here, you don't do anything, and then you see this, and you want to be bearish, because to me it's a low risk trade. You keep your stop here, and minimum target is over here. So I know you're big on spreads, but would you do just an outright put on that with the target down here, or again, you would be doing a spread, a bear put spread?
Probably a spread, and that's where volatility comes in, because if I thought volatility was going to expand or is expanding, quite honestly, I think for those of you that look at the charts, I would urge you to not only look at the charts, the candles, the Western, as Stephen calls them, the Western charts, but also the volatility chart. So you're going to want to look at the volatility chart. You can get that at fxoptions.com. And if you're seeing the volatility contract, the best way to play that is to probably look at selling spreads rather than buying them, or you wouldn't want to be a naked buyer of options when the volatility is contracting so quickly. So it's another thing to consider. Okay, great point. So let's go over what we learned today. We looked at how candles can be used in all time frames, revealing the market psychology, the bullish engulfing pattern, the white candle wrapping around the black real body, the bulls are taking over, and so forth. Protecting trading capital, we saw on the last slide, the market makes a new high, but a small real body really reflects that the bulls don't have full control of the market. And if you did buy on a breakout with a small real body or a doji, I would be doing it very, very lightly, if at all. Candles in context, I made reference to one of the questions about, what percentage of times the candles work. And this is what I mean by candles in context, using candles with other indicators and looking at trade management, looking at risk reward and so forth. East and West, okay, this aspect, and we were focusing on just basic Western indicators like support lines, but in the education I'll mention a little bit later on, in a little bit, coming up in the next slide or two, I'll tell you how you can find out my favorite Western indicators like Fibonacci retracements and moving averages and trend lines. But you have your favorite indicators, I'm sure. And so stay with them and then just add the Eastern, i.e. the candles, to your analysis, to what I call your 1-2 punch for successful trading. And this is what it's all about, how candles can improve market timing for option trades. So for those who who liked what we did here, the step-by-step approach, and really want to get to the topmost levels of education with candles specifically geared to Forex, this is my full day, my only full day Forex DVD, and this covers candles, my favorite candle signals, and there are subtle differences between candles in Forex and non-Forex. And for those who want to go even above this level, this is a one-day session. You can click on this when you let me just go back here quickly, and let's go through this very quickly. When you click on Add to Cart button, what you're going to do is have a one-time chance to upgrade to my Candles Essentials package, which includes candles and Western technicals. And I don't want to spend much time on this. You can just go to the link here. But there's just some nice comments we get from Stocks and Commodities magazine, and I love Judy's comments. Look at the great big smile, okay?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.